So I've recently chanced upon this content piece by Hidden Value Gems, where he basically outlined his entire thought process on why he decided to significantly reduce his Alibaba exposure. I think this is also a very good summary piece where he basically outlined most, if not all, of the bear theses around Alibaba today. So I think as fellow early or even existing Baba shareholders, sometimes we get pulled all over the place because it seems like every single China-related news is Alibaba's fault. Always good to always think back and to critically evaluate on whether there's still a very compelling argument on why Alibaba is a good investment or not. And I would want you to run through this entire exercise together with me to really look through point by point and to see whether you are able to address them personally and to think about how to look at this entire Alibaba investment thesis today. So Alibaba shares are down 75% from their 2020 highs. It is ridiculously cheap. So since 2015, its earnings have more than tripled while the share price has been flat. As you can see, the blue line being denoted by EPS and the black line, which is the share price. So it is trading at 9 times trailing PE. So the company adds back share-based compensation expenses to its earnings, but even if we were to reduce earnings from the amount of expenses, earnings multiple would still be quite low, around 10 times. Even more importantly, the company sits on a $63 billion net cash position. And they also have a diverse portfolio of equity investments in listed securities, which is around $34 billion, and a minority stake in private companies, which is roughly $29 billion. So taken together, net cash and investments has a value of around $125 billion compared to the market cap of $197 billion. So put differently, 64% of the company's market value is in cash and investment. The other 36% is the implied value of the core business. So this is some of the rough data or rough valuation metric, if you may, of Alibaba at the time of the publication. So some of the common valuation multiple, the free cash flow to market cap is trading at 14%, free cash flow to enterprise value 20%, which means that within 5 years, if they can continue holding on to their free cash flow, they can get back the entire enterprise value of the company, which is the market cap less cash at debt. The PE ratio, 9 times. So how can such a well-known liquid stock be so completely overlooked by the market? Surely, I'm not the only one who can calculate the valuation multiples. So here are some obvious explanations I thought about, and I wish for those of you who are existing Baba shareholder to go through this exercise with me. I'll go through point by point, you'll internalize the point and then you'll challenge your own investment thesis and whether you can come up with a compelling idea or argument on why Alibaba is still a hold today. Weibo has been a great partner in my own investment journey as they give you a seamless trading and investing experience with extremely user-friendly interface and custom layouts. So I know some of you purely invest from a fundamentals perspective, but it is sometimes interesting to be able to chart and see what the graph is trying to tell us from a price action basis. So Weibo has over 60 indicators and 12 charting tools to help analyze market trends. Also, they have their in-house screeners and alerts that I set so that I can be notified of an opportunity if Mr. Market decides to throw a tantrum. This is based on the fact that it does not require me to monitor the market every single minute. So remember to try these helpful features on Weibo today. So the Money Bull campaign has also been extended. So both new and existing users can now take advantage of these lowered requirements. Deposit a minimum accumulated amount of $2,000, maintain the fund, and activate Money Bull to enjoy cash vouchers ranging from $80 to $3,000. So did I also mention that Weibo have their invitee-only campaign for new users? So new users to Weibo who uses my link down below can fund and maintain any amount in their Weibo account for 30 days and win 10 fractional shares worth between $30 to $5,000. So remember to sign up with the link below now. Thank you Weibo for sponsoring this video. So the e-commerce market share reached 30% of Chinese retail, above the US and Europe. While Amazon may be facing a similar issue, it has arguably more potential to grow other segments like AWS, media, and international markets. So Alibaba could face more issues expanding in other segments due to a more stringent regulatory regime in China. Its international operations are probably the only segment capable of gaining scale. So I think I do largely agree in terms of the penetration due to the proliferation advancement of tech in China. Basically, every Tom, Dick and Harry has access to a smartphone and basically everyone is a customer of Alibaba. If you look at their ecosystem of annual active users, they basically have like 1.2, 1.3 billion. That's literally the entirety of the entire Chinese population. But that said, I think now the focus really is not in terms of penetration, but more so trying to bring more and more people up the value chain and to consume more. So that is really the focus for Chinese commerce moving forward. And I think the entire argument of Chinese retail being oversaturated and that's why all the e-commerce companies are going to suffer, I guess that's not the case. If you were to look at one of the biggest rival of Alibaba today, Pinduoduo, it has experienced a momentous rally. It's up 73% year to date. So you can't really say e-commerce is really the issue. And more importantly, if we were to superimpose what's happening to the Chinese economy by and large today, I do believe that e-commerce is quite cyclical in nature. But that said, Pinduoduo on the flip side is the consumer staple version of the e-commerce business. And that's why JD and Alibaba is getting punished because of the cyclical nature. And of course, let's not forget that Pinduoduo is expanding aggressively in the international market, which is why they are posing great record growth. That's also one of the potential reasons. But in terms of market saturation, I don't think China is there yet. Now, next, China's economy. So there are deeper issues with China's economy than previously thought, including hidden leverage, population decline, export restrictions, and the most important of them, moving away from pragmatism to ideologizing the economy through heavier state intervention in private industries. Truth be told, I'm investing in a company, not really a country, but I think there's valid arguments to this. But even with great amount of leverage, population decline, and even a deflationary problem in Japan, the Japanese stock market seems to be coming back. But let's just try to keep our views grounded in terms of the company's fundamentals, rather than many of these macro things that we cannot control. Now, moving on, which is geopolitics, US, China, and Taiwan. So this is self-explanatory. Personally, I don't think it's very self-explanatory. For those of you who do hold this position, I would like to have a deeper engagement and discussion around this point. So let's first talk about Taiwan. So a lot of the discussion around Taiwan today is that, there's an impending invasion. If they invade into Taiwan, a lot of the funds will be pulling out of China, and that's why China is uninvestable. But let's take a look. Is that really the case? So Taiwan, which is the issue at hand, you can see that the Taiwanese stock market index is basically just climbing up 45 degrees to the right. And you might think that this is just a one-year phenomenon. If you pull it back out in a 10-year time frame, it is approaching its all-time highs. And you're telling me that the capital market, investors are scared of the Taiwan invasion. Really, this is something I don't understand. If they're not even scared of the Taiwanese stock market, why does it have an impact on the Chinese stock market? Evidently, one is the alleged victim, while one is the alleged aggressor. Clearly, investors are placing the bets on the victim and betting that the victim is not going to be invaded. So that's a very big question mark to me. So on the second part, when we talk about US-China relations, I do believe some investors are worried that, the US government might mandate certain funds to restrict the fund flow to China, and that causes some sort of depression in terms of their stock price and valuations. And I completely agree. But that said, when I go back to the perspective of a retail investor, assuming that the company's earnings is not a value trap, they can continuously grow their earnings, hold their margins, grow their cash flow, grow their revenues, and also assuming that they are shareholder friendly, they are going to take care of shareholders, whether is it via buybacks or whether is it via dividends. To me, I still think that there's one most important thing that drives returns, which is earnings. Yes, in the short term, it drives up valuations, whether it trades at 10 times, 20 times, 30 times. But in the long run, it's the company's earnings and whether they take care of shareholders. So that's just my 2 cents. Now, on the sum of the parts, the SOTP valuation appears to be no longer relevant. So even if cancelling the IPO of Cloud is just a one-off issue, so weak market conditions may prevent listing other businesses on favourable terms. Likewise, I'm more concerned about earnings. Many of these financial engineering, they're just a stopgap measure for a short-term problem. Now, I think stronger competition, this is a much more important point. So this issue has been widely covered, but it's still important. Not only did Alibaba lose some market share in the past 2 years, mostly to Pinduoduo and Douyin, but it also had to reduce its commission for merchants and offer other incentives to remain competitive. So the company had to increase investments to adjust its business model. All this affected sales and profit margins. I think I largely agree. The writing is on the wall. And if you are in agreement with the common narrative around China today, where there's a lot of leveraging, consumer sentiments are at rock bottom, savings are at all-time high, and people are not willing to spend, then you will probably expect this kind of declining financial metrics. You can't tell me that on one hand, you do believe that China is in a very tough place, but on the other hand, you expect many of these companies to continue posing record margins, record growth. You have to stick to one story. At least for me, the story I tell myself is that, yes, China is not in the best position right now, but if you're to see through this short-term headwind, I do believe that many of these Chinese companies that I own will be able to ride along this trend or not. Now, I think the bigger issue is whether some of you might think of this as a structural headwind instead of a short-term headwind. So this is up for debate. Next, VIE structure. So this has been an argument since the first day of listing, but it has become more relevant now. So neither holders of shares nor of ADS own the underlying Chinese operation. So this is a VIE registered in China that are owned or controlled by China's citizens and not really by international investors. This I disagree about it becoming more relevant right now. Using that Pinduoduo example again, the year to date, Pinduoduo is up 73%. But if you to look at the disclosure of Pinduoduo, just scroll down and surprise, surprise, Pinduoduo is also governed by the VIE structure in their prospectus. So you are telling me that, hey, some VIE structures are worth much more than others. Pinduoduo's VIE structure, okay, makes sense. Alibaba's VIE structure, no, let's trade down the stock. I think that story doesn't really hold water as well. Moving on, growth versus margins. So I think on this front, it's the same thread that ties up the entire competition story as well. So in hindsight, a potential mistake investors made was to look at Alibaba's growth in aggregate while estimating its profitability at a segment level. What I mean here is that Alibaba was able to report strong double-digit revenue growth even after its core e-commerce segment ran out of steam. So the reason has been the strong growth in new segments, particularly cloud and the new format retail. However, all the new segments were deep in losses. Earlier part of this decade, Alibaba was growing at like 52%, 45%, 58%. While in the later part of the last 3 years, Alibaba was like 19%, then it plummeted down to 2%, and then last 12 months it's at 6%. Margins telling the same story, they were at 40-50% margins, or at least 30+%. Right now, it's at 17% on a trailing 12-month basis. But I think to really match up your story again, China is in a short-term challenge. Then of course, you'll see this sort of pressure on their margins. From a margin perspective, they kind of bottom out in 2022, and we are seeing some sort of an uplift in terms of their EBITDA margin. And also in terms of their growth rate, at least the analyst consensus right now is that they'll be high single digit or even low double digit, going back to 9-10% growth rate. So I think this is my biggest issue, especially for investors that keep bringing up this idea of geopolitical concern. So I think I wanted to enrich this discussion on two fronts. So are you concerned about the geopolitical risk in a practical implication or on a financial implication? So on the practical implication, meaning that, if the US-China tension continues to escalate, they start levying sanctions on each other, and many of these companies in the middle will be caught. So if you're really concerned about the practical implication, then you better be applying this sort of discount rate for companies that also have businesses and supply chains in China as well, from Apple to Tesla to Nvidia to even Starbucks. If you're not, then you're telling yourself two different stories, and the practical consideration of this geopolitical risk is really not up your agenda. You're just using it as an excuse. Moving on, which is the financial implication. So some investors, on the other hand, might be instead concerned about this financial fallout between US-China and maybe the US government just banning their own citizens from owning Chinese exposure or Chinese equities. So that argument probably hold much more weight, but we are already seeing it in real time, where many of these US mutual funds, hedge funds are pulling out of China. But let's also not forget the other side of the coin, which is investing into China today, it's not sexy. In fact, you'll be a laughing stock. People hear that you have Chinese equities, they'll probably laugh at you. And because the demand is waning, that's why many of these large fund managers like BlackRock, Vanguard, they are all closing their funds. And not really because the government telling you, you can't invest in this company or can't invest in this country, etc. On the flip side, if you're more worried about the Chinese government declaring all your investments to be illegal, I think there are many other levers that the Chinese government can pull on the US government. Our retail fund flow, we are fish in the ocean. Our billions of dollars invested in these Chinese equities are nothing compared to the trillions of dollars these companies interact with. Now, some other further observation. So Jack Ma's funds announced a plan to sell 10 million ADS, but they have since walked back on their claim because they believe that the current stock price is far below its fair value. So even if Ma doesn't sell their shares immediately, I still prefer companies where insiders increase stakes and founders remain highly involved in the business. Let's allow them to retire in peace. Not everybody is building a family empire like LVMH and they just keep acquiring shares because it's a family business. Constant management changes, I think this is an important factor. So the company replaced its CEO, CFO, and heads of the business unit several times, which is not a good sign from my experience. I completely agree. I think this also screams a lack of direction, and that's why we need to be even more careful during the investors' relation when we hear many of these different heads talk about their business units, and particularly so the CEO. Currently, I'm still not very convinced that they got everything sorted out, but let's give them some time. Next, a new pivot to AI creates risk to margins and cash flow. So a new focus for Alibaba is technology and specifically AI, away from the internet. So I cannot see how this would not lead to more investments. Perhaps the overall increase will not be material as the company can continue cutting investments in other non-core businesses. But even more importantly, success is not guaranteed. AI remains a highly competitive area and it will most likely be heavily influenced by the state. So I think first things first, we are talking as if this is the first time Alibaba is investing into AI. At least for many of these big tech companies out there in China today, at least over the last decade or so, they probably have been investing a lot in terms of their algorithms, in terms of their advertising infrastructure, in terms of how they recommend their stuff, their products for their consumers, etc. So this is not necessarily away from their core business. I think AI has been part of the core business of many of these big tech companies. We are not talking about a new monster in town. Secondly, betting big on AI and how the state is going to impede their advancement. He says that, I'm a shareholder in a company that plans to make a big bet on technology and AI over the next decade in a country with more signs that the government policy undermines the traditional market economy. So let's talk about this idea of government policy. You can actually do a quick search in the 14th Five-Year Plan by the PRC, which is the Chinese government, and just do a quick Google search of artificial intelligence. And surprise, surprise, under the main objective of the 14th Five-Year Plan, which is well underway now, cloud computing, big data, internet, blockchain, artificial intelligence, and virtual augmented reality will be supported. So this is coming right from the horse's mouth. And want to hazard a guess, which areas are Alibaba currently involved in? I can assure you that Alibaba has an interest in all the major themes the Chinese government is looking at now. So rather than saying that the Chinese government is on the opposite end of businesses and undermining the traditional market economy, actually we are having aligned interests with the government. Next, in terms of accounting consistency, he said that he noticed the total sale being reported lower in the latest account compared to last year. So I don't really know what he's asserting, so let's skip the point. So buyback is actually offset by new share issue. This is not unique to Alibaba, but the multi-billion-dollar buyback has had not a significant impact on the company's share count reduction. So the issue is share-based compensation, which diluted existing shareholders. So the share count actually only declined by 175 million rather than the 258 million that's purported, which is only a 6.5% net reduction in the share count. And it's quite interesting where we are living in a times where investors are saying that a 6.5% net reduction in share count is not a significant impact on share count reduction. Of course, I know that all things considered, people are saying that, oh, Alibaba has so many cash on hand. 6.5%, 175 million, 28.2 billion share repurchase, it's nothing to Alibaba. But at least it's a positive trajectory moving forward. So if the net cash is real, I expect the buyback to be more material. In general, in light of the share price weakness and the strong cash net position, I struggle to understand why Alibaba is not spending more on buybacks. Either it plans more spending on AI or some cash is not easily available. Maybe it is required for regulatory purposes, etc. So I don't want to engage in speculation here, but I do know that at least based on the last 2 years, many of these business leaders are expecting tough times ahead. So when you're expecting tough times ahead, you probably want to be more careful and prudent in terms of how you manage your financial position. That might potentially be one of the reasons, but we are all speculating here. So we'll see in terms of their buyback program in the upcoming few quarters. Next up, in terms of an inconsistent communication regarding cloud. On the same call this week, management spoke about the growth potential of cloud and tech. However, at the same time, referred to the US restrictions as hindering future growth. So management has not provided the details on how the restrictions could affect its cloud business and what it is planning to do about it. So from my experience, changes in communication, inconsistency, lack of clear explanation are all signs that something is not right in the company. So to me, I can wholeheartedly agree to this point. I think this is actually an extension to the entire direction of the company and the management change. They are undergoing some sort of major restructuring and reorganization right now. The direction of the company is still up in the air, and that's why communication probably has not been up to par. I do want to give the management team some sort of a benefit of the doubt now, but I think patience is running thin amongst many investors today. So the more traditional value group would point out that genuine bargains are found in situations where everyone is pessimistic. It is uncomfortable to own a particular stock, and it is embarrassing to talk about it at a cocktail party. Having an edge is almost impossible in a liquid and well-covered stock like Alibaba. Emotional edge pays off when a company's product remains strong and its management team continues to have faith in the company. Those 2 points are less evident in the case of Baba. Insiders are not buying its stock, the founder is less involved and plans to reduce his stake further, while the competitive advantage of this product has been eroded. So I think it's quite funny, it's two competing point of view. You say that having an edge is almost impossible in a liquid and well-covered stock, but when you think about the bear markets in many of these US companies, in a recessionary call, whether it's in COVID, whether it's in '08, whether it's in the trade war, investors just sell across the board. And people are concerned about whatever that you have just mentioned in your entire article. So I'm not too sure what his main point is. But he then followed up with, can it be a meta moment? So the author actually put together some of the key metrics for Alibaba today, comparing it to Meta in November of 2022. So indeed, both companies saw almost the same collapse in stock price, and Alibaba today is cheaper than Meta in absolute and relative terms. Having a higher cash pile, its margins and return on equity, however, is lower. Like alluded previously, margins of Baba seem to have bottomed out at least 2 or 3 quarters back. So you can see some sort of expansion now, and we look forward to whether they will continue expanding it back to the mean. And right now, a lot of investors are basically trying to guess where this mean is. And also, in terms of the ROE, which is the return on equity, the basic formula is to use net income divided by shareholders' equity. But let's not forget that how Alibaba actually report their net income might be slightly distorted because of the investments write-up and write-down, compared to Meta, which is a lot more vanilla. So even through the line-by-line item comparison, there's some nuances in mind. So don't just lump everything together and say that, Alibaba, because they have lower ROE, lower margins, that's why they're lousier than Meta. Case in point, when things are going down, when the story is getting more and more sour by the day, things will tend to look bad to worse. So you might want to take a more broader perspective and to zoom out a little bit more. In hindsight, Meta's problem has had an easy fix through scaled down investments into the metaverse. Alibaba, on the other hand, has to keep investing in its core platform, and on top of that, is planning a new pivot to technology and AI. As a fellow Meta shareholder as well, I have went through the entire crash. I bought in at around 200. I averaged down. My cost price was around 180. It went down to $90, which is, I think, 50% on my costs. I don't think Meta's problem is such an easy fix through scaled down investments. And Meta has been investing very heavily in terms of their ad architecture, their ad attribution model, in their artificial intelligence, in their algorithms as well. So yes, Meta is also investing in AI. But surprise, surprise, in the US market, when big tech companies invest in AI, that's an investment in the future. When Chinese companies invest in AI, that's a very dangerous endeavor. You don't know what you're doing. So some concluding factors. Alibaba is priced fantastically attractive, especially considering its cash and investment. However, this is a widely known stock, and there are reasons why the market may be discounting the stock. So emotional edge works in situations when a company's underlying business remains in good shape. In the case of Alibaba, there are signs that stronger competition and adverse regulation have eroded its competitive advantage. Insiders are not buying the stock. Price is an important but not the only factor in deciding whether to buy or sell a stock. So feel free to leave in the comment section down below what's your take on this article, and I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye.